In the previous video, I showed you exactly what a market cycle looks like and how to identify the major bottoms and tops of that market cycle. In this video, I'm going to show you the 4 phases which make up that overall market cycle and show you exactly where you should be concentrated or diversified within your trading and investment strategies within that overall market cycle. So let's get straight into it. Have a look at the slide over here. This is the 4 essential market phases which every single trader and investor should know. These are the phases which make up a total crypto cycle. So you get the accumulation phase, the advancing phase, which is where price starts to move up, the distribution phase where price starts to stall out, move sideways, and then the declining phase, which many of you would know as the bear market. So just a couple of characteristics which will help you to identify these phases. Bear in mind, we have covered this extensively throughout the ranges, trends, and the MAs and EMA videos which you've learned in the previous lessons. So feel free to go back there and recap if you are confused. But in a nutshell, this is what you'd be looking at. Number 1, your accumulation phase is generally after the market has bottomed. You get early adopters which start to come into the market, starting to buy up prices. That is measured with the 200 moving average flattening out and price action oscillating up and down around that region. Now, this is typically where you want to be concentrated in only 1 or 2 coins. And I'm going to show you a graphic of exactly what this would look like in just a moment's time. Let's continue the rest of the example over here. The price will then start to move up higher, starting the very beginning of an uptrend. Remember, from what you've learned previously, higher highs and higher lows. Then the 200 moving average will begin to rise. And ultimately, this is where you want to start diversifying your risk into multiple different coins. And again, I'll explain further why it is like this in the next video. The market will then start to move sideways once again, distributing where sellers start to dominate that price action. The 200 moving average begins to flatten out. And ultimately, that's your first warning sign that a potential major top is coming into play. And you would want to once again move from a diversified portfolio or investment plan into a more concentrated style of trading or investing. And the reason for this is very simple. It just means it's easier for you to manage your risk and cut positions when the inevitable takes place, which is the market begins to move lower and a downtrend commences, lower lows and lower highs on a macro time frame with price below the 200-day moving average. Of course, that is then your bear market. So if we go through to the next slide, this is what we're looking at. Concentrated versus diversified investing. So during those accumulation phases, which I've just shown on the previous chart, you're looking to be concentrated in only a couple of coins. And the reasoning for this is very, very simple. It's a mistake that so many traders and investors make. They get diversified way too early within the market cycle. You only want to be within a stable coin, Bitcoin, and Ethereum. 2 or 3 coins. Just choose 2 or 3 coins. And the reason why is because timing the exact bottom of a market cycle is a very difficult task which most people never get right. And that means it's easier for you to manage those 3 positions. When you have 20 to 30 different trades to manage, it's unlikely that you're going to execute to perfection, and consequently, you're going to make big mistakes and lose a lot of money. You need to then wait for confirmation from the market that it's starting to move into the start of a bull run, what we call the run-up phase, which on the previous chart has been labeled as the advancing phase. That's phase 2 of the market cycle. Once you start to move into that phase, you can start to shift from your Bitcoin, Ethereum, and Tether into a more diversified portfolio of altcoins, whatever the narrative may be for that particular cycle. These coins are just for illustration purposes. This is not a portfolio that we endorse or say that you should buy. It's just an example over here. As the market starts to reach euphoria and those peak levels, you want to start limiting the diversified portfolio and start moving it back into a more concentrated portfolio, consolidating all of those positions into less and less coins. So when the market starts to decline, you want to take that diversified portfolio and start to consolidate it all back into a concentrated portfolio, which is a lot easier for you to manage on a day-to-day basis, meaning you're not looking at 100 different coins at once, but instead only focusing on a couple of coins. And as that markdown distribution phase begins to take place, you already want to be concentrated into a mostly cash or stable coin position. And the market cycle will then at a later point repeat, and you know exactly what to do from that point onwards. So considering this diagram with the concentrated and diversified investing style, one thing that you can do to look at it from a different perspective is also consider this chart over here, which is the money flow phases. Now, many of you have probably already seen this diagram, which suggests how money flows within crypto. So if you have a look at the diagram, you'll see that generally speaking, the first phase is going to be Bitcoin. The flow of money moves into Bitcoin first before anything else, causing prices to surge. So that would essentially still be within this phase over here, which is why you want to be concentrated. Then money flows into Ethereum, but it struggles to keep up with what Bitcoin's doing. You get an overlap over there, and Ethereum goes back and forth between Bitcoin, one outperforming the other until such time as Ethereum completely outperforms Bitcoin, and you start to hear talks about Ethereum flipping Bitcoin. This is common within the cycle, and this will usually take place once you're near the end of this accumulation phase. As you start to overlap from the accumulation phase into the run-up phase, you will start to see large caps running. This overlap phase is where money starts to flow from Ethereum and trickle into the larger cap coins, and we see large buy-ups happening. The large caps then start to run. These are going to be the layer 1s, layer 2s, or whatever the narrative is of that particular crypto cycle, and these large caps start to completely outperform both Bitcoin and Ethereum. That would happen in this phase over here. As you near the end of the run-up phase and you start to move towards the distribution phase, this is when the market cycle is in peak euphoria, and you'll start to see full-on alt season. This is where the low caps and the mid caps start to outperform Bitcoin, Ethereum, and the large cap coins, and it is full on hype within the market cycle. You don't want to be holding onto these coins for a very long period of time when you get into the cycle. This is when you want to actually start diversifying your portfolio into a concentrated portfolio and limiting the amount of altcoins that you hold as you move into what would inevitably be the next rundown phase. At this point, you have full-blown altcoin season, and it's inevitable that the market will eventually have some sort of a major blow off top and the cycle will end. And then you start to look for the new cycle to begin once again. So now that you understand the broader crypto cycle, the 4 different phases within the cycle, you understand the money flow system within crypto, you understand why you should be concentrated and diversified at certain points within the cycle, you now have all the tools at your disposal, all the understanding at your disposal to absolutely crush the next crypto market cycle, which means you can make millions if you put your mind to it and you place the right bets at the right time. In the next lesson, we'll be going over portfolio structuring. The reason this is such an important lesson to conceptualize and understand is because you need to know how to manage your relevant portfolios, and you need to know when to rotate from one portfolio in the next. So I'll see you all in the next lesson.